Good morning, this is Ian King Live, an hour of business and economic news from the heart of the city. Now, Haleon, the company behind consumer healthcare brands such as Sensodyne toothpaste, Centrum vitamins and Panadol painkiller, made its stock market debut this morning. The company was spun off from the drugs giant GSK in the biggest demerger Europe has seen in 2 decades, and it's the biggest company to arrive on the London stock market in a decade. I've been speaking to the chief executive, Brian McNamara, about what the demerger will help them achieve.
So Haleon, which demerged just a little bit over an hour ago from GSK, is an amazing business with category leading positions, great brands. Now, GSK has been a great owner of this business for the last number of years. You know, we're able to do the 2 largest transactions in the industry, and it hasn't held us back at all. But I would say going forward, GSK's number 1 capital allocation priority is pharma R&D, which is exactly right for GSK. And for this business, we now will have an executive team and a board that's 100% focused on this business with our own capital allocation priorities, and also the ability to create our own unique, distinct culture, create systems and processes that are fit for purpose for a consumer health business of our size and scale.
Now, the product portfolio comprises 5 categories. Which of them has the strongest growth prospects in your view?
So all 5 categories we are excited about. So therapeutic oral health, pain relief, respiratory health, and digestive health, and also vitamins, minerals, and supplements. But we look across those categories, we see the growth opportunity in the market of 3 to 4%. But vitamins, minerals, and supplements is the faster growing of our 4 categories, where we see 4 to 5% growth from a category perspective going forward. And we fully expect to deliver stronger growth than that.
Are there any obvious gaps in the product portfolio?
Listen, we've done a lot of work over the last few years. The Pfizer deal strategically gave us a number 1 position in vitamins, mineral supplements, gave us number 1 positions in US and China, strengthened some positions in key categories like pain relief, where we added Advil, and we divested 50 growth dilutive brands over the last 2 years. Actually, 90% of them were declining. So we feel great about the portfolio and the opportunity to continue to deliver the kind of organic sales growth that we've committed to in the 4 to 6% with what we have. That said, we have the capacity and ability to do bolt-on acquisitions over the next couple of years, and we'll be very open to, opportunities that strategically make sense for us and can enhance our growth profile.
Tell me about the inflation that you're grappling with at the moment. How easy is it to pass on higher input costs to consumers right now?
Well, I think a couple things. One thing that's really unique about this consumer healthcare business is we tend to be less exposed to some of those commodity and commodity-related costs. It's less than 10% of our overall sales. And that's because, the products we have tend to use active pharmaceutical ingredients. We tend to have smaller packaging, less use of plastic. So that said, we are seeing the inflation everyone is seeing. And pricing is, something we're always very thoughtful about. You want to make sure that you're doing the right thing for your consumers and customers and for the business and your shareholders. So always challenging times in these kind of environments, but we feel really good about our ability to price where it makes sense. And also the fact that being a little less exposed, we can be very choiceful about what makes the most sense for our business and for our consumers.
Now, post the demerger, you're carrying something like £10 billion worth of debt on the balance sheet. Given that that's supported by roughly £31 billion worth of equity now, is paying down debt going to be a priority for you?
Yes, we are carrying 4 times leverage, and what we've committed to is we would be down to below 3 times by the end of 2024. This is a really high cash flow business, so we feel comfortable with that level of debt. And certainly, given we've been able to do the 2 largest transactions in the industry in the last 7 years, it's a reasonable place to start. But certainly, we want to get our leverage down, and we've committed to that to the investment community.
Now, as I mentioned, your market capitalisation currently stands at around £31 billion. Unilever, of course, offered Glaxo £50 billion not so long ago. Are you likely to remain an independent business for very long?
So listen, first of all, it's really hard to react to any market cap. It's such early days. And the Unilever bid also was based on an enterprise value, which would include that $10 billion in debt and also would have a takeover premium. So listen, I am so convinced this is going to be an amazing independent listed company. And I'm very focused on delivering the commitments we've made. And if we do, I think we'll generate, when we do, we'll generate significant value for shareholders in the short, mid, and long term.
That was Brian McNamara from Haleon speaking to me a little earlier on.